Guys, if you have understood equities, if you have understood, let's say, bonds, or if you have understood money market instruments or preferred equities, or even business for that matter, like how business works, then only you can understand the importance of derivatives. Did you get it what I said? So derivatives is not only for a trading, but for a common people, I think they have misunderstood this, and they believe the derivatives, which they are for only, to do tradings and burning out your cash. But in my opinion, derivatives is not for that only. See, derivatives, if you ask me, derivatives are like, it's a very beautiful, basically, it's an invention, and it helps you to protect your investments, protect your assets, protect your business from the market uncertainties. But if you try to, trades in derivatives, that may even can be disastrous for, you. Why? Because derivatives, it's like it's like a weapon, and it can happen anything with that, let's say, person who want to carry that weapon. So why so weapon and why so not, we'll discuss everything in details. But today we'll focus on general understanding of derivatives. I'm not going to means get into more in details. We'll go through the case studies, or we'll go through the some scenarios, and then tomorrow we'll have a dedicated basically session on derivatives, but we'll discuss the actual things of a derivatives. So today we'll focus on background basically. Okay. So let's start with example directly. But before that, let me just brief about derivatives as a definition. Derivatives, it means, guys, it's a contract of underlying financial instruments. Okay. So the key focus would be here on underlying assets. Derivatives, it means it's a contract of underlying financial assets with the commitment that the trades can be executed in future, right? Like buy and sell depends on the market situation, with synthetic features like stop loss, or derivative may offer facility like to hold the large amount of contracts by paying just small premium. So such a instruments we can call it as a derivatives. So derivatives can be traded or signed contracts for currencies, stocks, bonds, businesses, weather, and so on and so forth. All right. So I hope now you got it. So derivative, that means what exactly? So this is something, it's a definition. But now if I talk about underlying assets, see, we have discussed about, guys, loans. So that comes under underlying assets. We have discussed about bonds. That comes under derivative, underlying asset. We have discussed about government securities. That comes under derivatives, underlying securities. We discussed about equities, right? So that comes under underlying assets. So we discuss about a lot of different financial assets, even including your agricultural land or open land, your any the durable items, including any rare car or rare watch, that all comes under underlying assets. But now if I define the derivative term, as I said, derivative, it means it's a financial contract. Okay. So contract between buyer and contract between seller. But why they'll sign the contract? Any guess? Why buyer want to sign the contract? Or why seller want to sign the contract? And for what? Buyer and seller, let's say both want to sign the contracts for let's say Wipro company stock, right? So buyer and seller both can sign contracts. So design this flow, guys. It's a very important one. They can both sign the contracts and same contracts can be settled later date. Settled in future. Settled in future. So how does this work? Let's say stock price, it was 100 at the time of signing contract. So seller was expecting price will goes down in the market. Okay. Maybe let's say from 100 to 80, right? And on other hand, so buyer is anticipating price may go up from maybe 100 to let's say 120. See, both buyer and seller both has a probability, guys. See, not only stock market, but also, anywhere or everywhere, without probability, you cannot achieve anything. So probability is a very essential like everywhere. See, both like buyer and seller, they both have a different probability. So one is saying, look, price of a same stock, it may go up. But why price will go up? Maybe buyer has a different probability with a different conditions. Like maybe due to geopolitical issue, let's say price may go up. Maybe due to company has acquired XYZ company, maybe due to that price may go up. Maybe let's say due to Trump tariff policies, there would be a hidden benefit to this company, and that's what the buyer maybe thinking that the price may go up, right? Again, there is no surety of a price may go up or increase of this particular stock in the market. So it's just a probability. Same for a seller side. Maybe seller is thinking, exactly the opposite way, like other way around. Stock price may go down from 100 to 80, maybe because of, let's say, due to what you can say, due to geopolitical issues or Trump tariff, and so on and so forth. Both had just the probability with them, and on the basis of that, both they have decided to sign contracts of a you know Wipro stocks. Let's say quantity, it could be 1,000. So basically, buyer and seller both they have decided to execute the contract of 1,000 quantities of a Wipro in future, maybe after 1 week or 1 month or 1 year, depends, right? So let's say in this case, we are assuming that the contract was signed for 3 months. So after 3 months, on the last business day of, let's say, third month from today's date, the contract will be settled. This is what the contract, it was signed. Okay. Now let's assume it. So this contract was signed on a 1st of January, and today is 31st of December. Sorry, not December, January, February, March, 31st of March. So on today's date, so contract, let's say, now settling in the market. But at this time, at this point in time, let's assume it, the current market price of a same Wipro stock, which is at 110 rupees per share, right? 110. Now, if I ask this question to you, in this situation, which counterparty, which counterparty would be in profit? Come on, buyer, seller, who? Who will make the profit out of this? Come on, who would be in profit? So now, okay, let's discuss. So if I talk about now the situation, okay, so buyer had anticipated that the price may go up from 100 to 120, but as per the let's say at the time of settlement of contract price, which is at 1 so means 100 and 10. So basically this contract looks like in the favor of buyer. So now in this case, buyer would be in a profit of, let's calculate it, profit of how much? Come on, let's calculate it. uh, Contract price, contract price into quantity. So we have 1,000 quantity into price, which was 100. So total like, so this was the, means at the time of contract price was this, but now at the time of settlement, let's say current market price, because contract settled at current market price which is at 110, and the total would be like 1,10,000. So just minus, you know contract contract value, sorry, current market price value minus contract price value is equal to your net profit and loss. So in this case, as we know, we have a 1,110, which is the current market value minus contract price of 1 lakh. So which would be like 10,000 as a profit from this trade. So you may see like brokerage or other, expenses, definitely it will be deducted from this profit. And sometime, the expenses which is basically charged on the total value, buy value or sell value. In this case, the buy value is, let's say, 1 lakh. So you might see other expenses like stamp duty, security transaction tax, broker expenses, or legal expenses, right? So there are many things so that you might say, which can be even deducted from this profit. So basically, this is how, derivative contract works. But now if I talk about, the other technical terms. So now if I ask this question to you guys, in this particular contract, what was the underlying asset? Come on, what was the underlying asset? Underlying asset, which was Wipro Securities. If you remember my definition, what I said, so derivatives, it means it's a contract of financial instruments where parties, both can sign the contracts on underlying securities, and they basically track the movement of price, whether it is increase or decrease, and accordingly, they settle the trades. So that's how derivative works. So basically, in this example, the stocks become underlying asset. And as I said, underlying assets, it can be interest, it can be stocks, bonds, debenture, loans, any businesses, weather forecasting, or any kind of, the assumptions also, if you, or if you have anything as such which you want to, even agricultural commodities, oil, that all comes under underlying assets. Okay. So that all comes under underlying assets. So basically, without underlying assets, we cannot sign or we cannot trades in derivatives. So we should have to have something, including even indices as well. So we should have to have something as an underlying. Then only we can sign contracts for derivatives, right? So now if I talk about the underlying, so underlying, it means, I hope now you got what is underlying exactly. So underlying, it means it's an asset. Okay. So here we discuss about two things. One is this stock price. The stock price, so that's become your contractual price basically. Contractual price of underlying securities. Underlying assets. Okay. Then another one is the settlement price. Let's say at the time of settlement or on the day of settlement, the asset price which was in a market around 110. So that's become the future price. Future price in a stock market or any market, I would say. Okay. So basically now, if you put it everything in the sequence, like buyer and seller, will call it them as a uh, counterparties. So counterparties basically sign contracts on underlying assets for, let's, and there would be, the price, it means that's become contractual price, and then they settle the contracts in future at a future price, whatever would be the future price, at that price. So contracts can be settled. If price goes up, then buyer would be in profit. If profit goes down or value goes down from the contract price, then basically, the seller would be in profit. So in this example, so this become your contract price, right? So means we have discussed the first case where the price of a stocks which has gone up by 10 rupees, right? So buyer was in profit. And this is, something, it's a very simple or plain example of derivatives. So this is how derivative works. Now your question would be, or let me just, brief about it. Let's say, let's assume it, we don't have any derivatives contract in place, or we don't have any mechanism such as, let's say, derivatives contracts kind of. Now, if I ask you question, let's say you wanted to buy 1,000 quantities of Wipro, but you don't have 1 lakh rupees in your pocket, then would you be able to purchase the 1,000 quantities of Wipro? Let's say you wanted to, or you want to buy 1,000 quantities, but as a buyer or seller, paying capacity is, let's say, only 20,000. Let's say same for this one. If losses incur, both only can pay 20,000 max. This is what their capacity is. Now you tell me then, your capacity is low, but still you want to acquire assets, right? Asset, let's say with worth of 1 lakh, like which is 5 times, higher than the your capacity, correct? Because your current capacity is 20,000 to pay to acquire assets, but in a, let's say on the ground, need 1 lakh to acquire the assets, or 1,000 quantities. But let's say in reality you don't have a 1 lakh to pay it. So now you tell me, and without derivatives, wouldn't it be possible to acquire assets? Come on. नहीं होता ना पॉसिबल, या होता? Come on, tell me. डेरिवेटिव अगर नहीं होता तो फिर पॉसिबल होता क्या? Now if you ask me, I would say yes, hota. Why not? Because derivative come into, I think, existence in 1962 or 1964 somewhere. Date maybe, little change, but I think, or I'm not sure exactly, but I think this came into existence in 18th century somewhere, 1862 or 64 something, but I'll have to check the date exactly, or else you can check on internet, right? But before that, without any derivatives, guys, buyer and seller both, they were able to exchange goods, right? Because we have a history of 7,000 years, or even more than that. And this planet has a history of 35,000 or 35 lakh something years, right? So, so it means in the history also there was a derivatives, but that derivatives we used to call it like a barter system. Barter, it means the exchange of a goods versus goods. Like I'll give you price, you can arrange, let's say, wheat for me, or I'll give you, let's say, XYZ things, or you can arrange cotton for me. So that was kind of a swapping, process. It was exist in the barter system. But later on, the world was looking for something else, like, uh, like kind of a transformation, I would say, because the way for a bar, in a barter system, like there was a barter system for exchanging or swiping goods. So in finance, we have in a finance we have a swap contracts, so which exactly work like a barter system. So in a swaps, basically you can swap currencies, you can swap interest rates, you can swap investments, you can swap instruments like equity versus bond, bond versus equity, equity versus preference shares, or one company share versus another company. So it's a swap. Even you can swap uh, business returns as well. If you want to exchange the business returns, you can do that. Again, that comes under swaps, right? So that all things, guys, come into, I mean, we have taken from the barter system into the swap system. Okay. But again, swap was like uh, restricting people to exchange goods or exchange, let's say, product in cash, because there wasn't cash exist. But when the world invented currency, like, to compute goods and services value in a cash, and then the industry was looking for enhancement in a swap contract. So at that time, so we got forward contracts. So forward is basically, it's advanced version of swap contracts with little modification. In a swap contract, like this is the exactly, the example of swap contract, because in a swap contract, parties that doesn't require to pay any, minimum amount or anything as such, they can simply sign a forward contract and execute contracts, at a future date. All right. Wait. Uh, sorry. Let me take what. Sorry. ड्यू टू कफ, आई मीन, गले में खराश ज़्यादा आती है, और एनीवेज, sorry. We were talking about the evolution of, the swap contracts, or derivative contracts, basically. So forward is the advanced version of, the swap contracts, right? But now let's say we need, quick settlement of trades. We need more assurance. We need more safety, security, because in a swaps and forward contracts, you would see a lot of frauds and default cases, because there is no central counterparty. Nobody is asking for a guarantee. Nobody is asking for a deposit. So what if, let's say, you are in a profit. At that time, what if your counterparty denies to pay you off or pay you your benefit? So it's a very difficult, in that case. And that's when the industry was looking for a something which can resolve the liquidity problem, reduce the risk, and faster the transaction. At that time, the industry invented future contracts. If you ask me the difference between future and forward, only the difference is future, which is not, let's say future is listed one and ask for a, advance amount in a contracts before execution. And that advance amount, we call it as a margin. But forward contract, which are like, not listed on any stock exchange and even not ask for any advance amount for execution of the contract. So that's become forward contracts. बट दोनों एक दूसरे के चट्टे बट्टे छोटे बड़े भाई है ऐसा दैट यू कैन अंडरस्टैंड इन अ वे लाइक द future which is listed on a exchange, there is no risk as such. The exchange take the all risk and ask for even margin or advance amount to both the counterparties, and even take actively participation in the contracts, monitor the price, and execute the contracts on time. But again, guys, future was also like, inefficient in a way, like because future contracts need a margin 10%, 20%, 30%, 50%, depends on the risk in the contracts. Then industry was looking for something big, like even if I pay, let's say 1% of, contract amount. So are you able to hear me, guys? Okay. So now, as I said, the industry, it was looking for some more enhancement, and that's when the the what I would say, the options came into picture or came into existence, I would say, with more advancement. Like even if you pay 1% or 2% amount of a security, still you can, enter into the contracts. So if I talk about same example, let's say same example, but if I put it in every contract, how the dynamics changes, I'll explain that. Let's take a same example, okay? Wipro share price, which is at a stock price, which is at 100. Let's talk about how derivatives basically it will help you to execute contracts or to make money out of it. Uh, 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 uh. Okay. So this is the cycle basically. Let's say stocks. So that's become goods actually. So if you want to purchase a goods or any stocks, you need to pay in full. You need to pay in full amount. Correct? Or as I said, so previously we had a barter system. It means if you don't have a cash, then the parties like used to exchange goods versus goods. But now in a modern market, we have a currency, and currency basically facilitate to carry value of certain goods and services with you without actually means carrying goods and services or any assets with you. So basically the currency is the medium to exchange goods and services in a cash. All right. So now if I talk about, let's say, in a stocks, so there is a way like you can pay full amount, that is a one way, or else for a same stocks you can pay partially. Let's say pay only 20 rupees, hold the stocks or hold the goods for the day, and at the end of the day you can sell it out. So that's become your intraday. So you can just take a positions, or you can pay some amount, let's say 10%, 20%. See, actual stock price, Wipro stock, the price which is at 100. See, for a same stock, you have a way to acquire stock and pay full amount. So this become your, let's say if you pay 100, so that become your cash buy, cash trade. So it means you're ready to pay in cash, like let's say full amount. Okay. If you have a cash, you don't need to go for a derivatives. Why? Because you have a cash, pay it, hold it, and then you can sell and generate money out of it. That's the one way. Second way, let's say you don't have a high amount of cash. Maybe you have a, let's say, 20 rupees in your pocket. So then you can go to the market, buy one Wipro stock, hold the stock, or take the position in the stock for, let's say, max one day, and sell that right before end of the day. So that's become your intraday positions or intraday trades. Now, what if, let's say, you have holded or you have held, sorry, you have held the shares in the demat account. Oops, my bad. Let So let's say you have, you have the Wipro security which is with you, but now you have decided to exchange the your security exposure like profit and loss, including dividends or corporate action benefits, with someone else for a fixed price. Let's say it could be 10%, fixed interest payment for per annum. So it means someone is really interested to take the control of your portfolio for a 1 year, let's say, and that same party is ready to pay you 10% of your portfolio value as a fixed amount to you. So if, let's say, if there is a profit, if you say huge profit, so you can transfer that entire profit to that counterparty, and counterparty will pay you 10% fixed amount of, you know, your portfolio value. So basically, this is how uh, the swaps works. Swaps, it means it's a exchange of goods and cash flows. So counterparties, they can exchange anything including, let's say, cash, currencies, goods, or so and so forth. For example, let's say as a party, we'll discuss each one in details tomorrow, but I just wanted to, help you understand how, I mean, same stocks, how you can link with the multiple, trade strategies, and how it works exactly. Let's say you are holding one share, Wipro share, and you have a cash trade in your portfolio basically. So it means you have a cash in, cash buy in with a price of 100. So there is a someone as a party ready to, exchange cash flows. Party B ready to exchange cash flows. So what it means, let's say this party A can send the exposure of a stocks to party B, and party B may share, the fixed amount, let's say 10%. If price change it could be positive or negative, or any benefits received on or above 100, which is a contract price, that goes to the party B basically. See, this is how you can see a terms in, guys, in a contracts. Okay. See, for same security, if you have a securities in your demat account, and if you are looking for, let's say, some fixed amount of return from your portfolio, so what you can do, you can simply find someone who can help you to, let's say, participate in you know the swap agreement. So you can sign swap agreement with the parties, and then parties may pay you fixed amount, and party will take the control of your portfolio. Party B. So now if you ask me, sir, how does this work? What if, let's say, stock price changes from, same example, let's take a same example. Let's say stock price changes from 100 to 110, right? So in this case, the payout from the contracts. So it means, let's say this one is party A. Party A actually holder of security. Party A, this party will pay 10 rupees, which is on and above, as I said, on and above the 100 contact price. So that would be like 10 rupees extra. There is a difference in the price, right? So 10 rupees party A will pay to party B, and the 10% interest on 100. So that also would be like somewhere around 10 rupees, right? Because the contract value is 100, and 10% on 100 would be 10 rupees. So party B will transfer 10 rupees to party A. So this is how basically, guys, things work. So now your question would be, sir, in this case, if you see there is no actually gain to any party, then why parties will sign a contract? Yes, absolutely right. See, if there is no gain, then that's absolutely fine. But what if, let's say, if I little bit tweak the trade, and the gain, it was, let's say, the current market price, which is at 120. So now in this case, if you see the gain for a party B, it will increase, right? Because then party A will have to transfer 20 rupees to party B. Why? Because there is a change in the underlying stock price from 100 to 120, and party B will have to pay 10 rupees to party A as a fixed interest payment, which was committed. See, guys, same asset which you have already, purchased and put it in demat account, and now on a same assets you are looking for a multiple obligations to generate more and more income. Now your question would be, sir, as a party A, let's say if I'm holding security, so why should I do this? You should do this because, let's say, there is a 500% or 600% gain in your securities, and at that point in time, let's say you're thinking like, you don't want to take a risk. What if the price goes down? If price goes up, there is no harm, right? If price goes up to you, because already you are sitting on a huge gain, but due to market circumstances, you have a fair in mind, what if price it goes down? So you may lose money, right? So you may lose money. So if you don't want to lose, let's say, money or portfolio value, then you can basically swap your portfolio exposure with the party B, if the party B is ready to take it, the risk. Now your question would be, sir, why party B will do this? Look, guys, party B will enter in this contract because initially party B is, let's say, not paying single penny to you, because without paying single penny, party B is actually technically holding your stock portfolio, right? So if, let's say, and in this example, if you see party A has made a party B has made a profit of even, gross profit, if I talk about 20, net would be 10, because the interest cost, if you just, debit from the gross profit, so net profit would be 10. So party B basically, which is in a profit, profit of 10 rupees. See, without spending money, without means doing anything, just party B has assigned swapped. Who is holding securities, actual underlying securities? Party A. Who purchased securities? Party A. And who signed the contract, swap contracts, which is a party B. That's the beauty of swaps or derivatives, guys, because derivative contracts allow parties to execute them without paying single penny. But let me tell you something. In this, contract, you might see huge risk. Now your question would be, sir, why? There would be risk because of because of what if, let's say, means when you have a profit in a trade and the party A is now denying to hand over that profit to you, because it's a direct contract between party A and party B. And it is a possibility. What if your party is in Mumbai, you are in Delhi, and now when you have a profit, your party is not, your party is basically denying to pay. Then now you tell me what will happen in that case. So you would see huge risk. So again, so it means, see, parity is the swap offers a lot of the facilities, like without paying single penny, still you can sign a contracts and get into it, make a profit out of it. At the time of settlement, but definitely you will have to uh, I mean pay the amount whatever it is, whether it is positive or negative. So that's become cash flow. But initially you don't need to pay anything. But industry was looking for a transformation, and then the forward contracts come into picture. So forward contracts, they are same like exchange of goods and services, but forward contracts offer flexibility even. The example remains same for a forward contracts, like parties, basically they exchange the benefits, but forward contracts basically, focused on the signing contracts by like not paying anything. Just sign a contract, hold in the trade, hold the trades or take the position in the trades maybe for 1 month, 1 year, 2 year. And then, once you have a profit in the trade, then you can take the exit. Now your question would be, look, I'm already holding, 100 rupees shares. Why should I sign forward contract on my securities? You can sign a contract on your securities. See, again, it's a game of probability, guys. When you feel, let's say your stock, the current market price of a stock, which is at 100, right? You might feel, let's say, price may go down from 100 to 80. Then directly you will have a loss from the securities or security price by 20 rupees. So if you want to, let's say, reduce, in this case, there would be a loss of 20 rupees. And let's say you're at a seller side. So if you feel, or if you have any probability or research in place which talks about price may go down, then simply you can enter into forward contracts without paying single penny. You can find, but yeah, you need to find a counterparty which has a exactly opposite opinion, you know because you have a research which says downside impact, and let's say you need party which says, let's say, there would be upside momentum in the stock price. Then you can sign contracts on Wipro stocks, okay, for 100 rupees. And then you can see a moment. What if, let's say, price goes actually down? If the price goes down, and if you are in actual losses in your portfolio, you don't need to worry about it. So basically parity B will offset the losses, whatever it is, 20, 30, 40, 50, 60, XYZ. So parity B will settle the losses, because in a portfolio you may have a losses, but in a contract like forward contracts, parity will pay you the price. But now again your question would be, sir, what if we have a losses in a portfolio and even we have a losses in forward contracts? Is it possible? Yes, it is possible. What if, let's say, the you have a sign contracts for like, instead of sell, you have a contract of buy. So it means you had a prediction like stock price may go up. See, already you are holding asset. So you should not sign contracts for a, let's say, price goes up, because you have purchased security, because you have anticipation that that price may go up, and that's what you have purchased it, right? And again, if you enter in the same forward contract for a same reason, like if you, let's say, your assumption or probability says like price, if the price goes up, then you may make a profit out of it. See, if actually price goes up, definitely you can, make a profit out of it. Like, you would be in a profit in your portfolio, you would be in a profit again in a forward contracts. But what if, let's say, price goes down? Then in this case, you will have a double the losses. And that's what I said. See, derivatives, they are like a weapon. See, the big people, like rich people, they deal in a swaps, they deal in forward contracts. Okay, listen this very carefully. The big people, they deal in a swaps contract, they deal in forward contracts, and poor people like us, who actually purchase stocks and bonds by paying full fees or full amount. That's the actual pain. For example, let's say if you have a 1 lakh, then you will have to buy a stocks and hold in a demat account. So it means you will have to spend entire your money to purchase stock. If I talk about rich people, they don't pay single penny to anyone. Through brokers, they basically sign swap contracts, forward contracts. They take a positions instead of buying, let's say, 1 lakh rupees goods. Basically, they have a liquidity, so they can buy 1 crores contract, sign a contracts for 1 crores, because they know it, how much losses, that they can bear, or how much maximum losses would be in contract. So they directly sign a swap contracts, take the higher risk and make a higher profit out of it. In a swap contract or forward contract, there would be a risk of default, means counterparty may deny to pay, the profit. But the most of the profit parties they make in a swap contract, guys, and even forward contract also, because here you don't need to pay any initial amount, you just need to park amount in your bank account, but meanwhile you can utilize that amount for a different purpose, and you can multiply your profit. So in a finance, what I have seen, like, there is a discrimination. If you are not a rich, then you will have only limited access of financial, facilities. If you are a rich, then you can access bank credit, you can access, the different contracts. But if you are a middle class or poor, for a poor, again, there is no scope, but for a middle class, you have only limited access of a financial facilities or market facilities. And that's what big people, they make a huge profit, and poor or middle class people, they actually lose everything in the stock market, because intraday is risky. To hold the stocks by paying full amount, again, which is risky. But without paying single penny for a, let's say, swaps and forward, there is no risk at all. If I would be in profit, counterparty will pay it. If I would be in a loss, then I'll pay it, and that will decide at the end of the contract, or maybe, quarterly, yearly, or maybe monthly, it depends, right? So that's how basically, guys, swaps or forward contract works. Okay. Now, if I talk about, let's say, other techniques or other ways to do a, and sign a contract for a same, let's say, Wipro, the another one is like future. Future is the advanced version of forward contract, because forward, which is not listed one, and you will not ask for any single penny in advance. Okay, the way in a, let's say here, if you see stock market goods, so that you can buy as an intraday position by paying 20 rupees. But in swaps, you don't need to pay any single penny initially. Even in a forwards, no need to pay any single penny at all. But in a futures, again, so this is something like, without, if you don't have a securities, fine, still you can, still you can sign the contracts. For example, let's say underlying security, it could be Wipro stocks, but actually you don't need to hold any underlying securities. It's just like select the contract for a Wipro and enter in the contract. But here need to pay actually margin. Margin, it could be 30 rupees or 40 rupees, or even, sometime full, depends on the security risk. But if you want to enter in future contract, so you will have to pay margin for per security, and that's become, to enter in the future contracts would be risky game. Why? You will have to pay higher margin. Let's say if I now 30, let's say, if I calculate 30%, but again, if you enter in future contracts and if you want to, let's say, buy more and more quantities, so if you have a capital of 1 lakh, 1 lakh divide by 30, so almost you can buy 300, something quantities that you can, buy it, right? 330 uh, something quantities that you can buy. Okay, so it means, see, future basically offer you that facility to buy more quantities, because here in this case, guys, look at this. You can buy maximum quantity of 100. Here you may purchase, maybe let's say 20 rupees into 2000 quantity you can max, buy through intraday. In this case, means in case of swaps and forwards, basically need to hold assets. So if you have assets, then only you can sign it. But in this case, we had a, let's say, the Wipro stocks in the portfolio, so we can sign contract on swaps and forwards. Need to hold assets, so no need to pay initial amount. Then finally, your come into your options. Option again, which is advanced version of future, but same quantity, means same, the trade, if you want to just buy it under, let's say, under the future contract. So in a 1 lakh capital, just divide with 1 lakh, divide with 30. 3,000 quantity which you can buy it. But I think here we wrongly updated. So you have 4,000 quantity you can buy it. And now under option, need to pay premium to buy rights basically. Buy right or sell right, which you can purchase. And let's say the premium is, let's say 5 rupees, right? Just you need to pay 5 for one quantity and see how much quantity you can buy. 1 lakh divided with 5. So you can buy at least rights for a 20,000 quantities. Look at this, guys. In which contract you can buy more and more quantities? Can you guess? See, the Wipro stock price, which is at 100, and let's say your capital is, let's say 1 lakh. See, with a 1 lakh rupees capital under normal trade, like cash trade, you can buy only, sorry, 1,000 quantities. Okay. You can buy only 1,000 quantities. Under intraday, you can buy, let's say 4,000 quantities. So your capacity has been multiplied by 3x. Why? Because in intraday, you'll have to buy today and sell today only. Now, if I talk about swaps, so swaps basically which offer opportunity to gain or earn something on your portfolio value. So whatever would be your portfolio value, so you can generate extra income from your portfolio. So basically, founders of the business or promoters, they go for a swaps, they go for a forward contracts because they cannot buy and sell quickly. So if they want to generate extra income from their freely parked securities, then they opt for swaps. So they actually swap the securities with someone and generate some additional income. And in a swap contracts, you don't need to pay any single penny. So basically that contract would be on the basis of your portfolio. If your portfolio size is 1 crore, so you can sign a contracts with someone else for 1 crore and get into it swap contracts. So this is how basically swaps or forward works. Now if I talk about future contracts, future or options, in a future you need to pay margin, but still you can increase the size of the quantity. So it means you can increase your capacity by 3x or 2x to acquire more and more quantities. And option literally means you can multiply your capacity to acquire, let's say, maybe 100x quantities from, if you just multiply the price of the contract, guys, just multiply it so that you can understand the you know the leverage potential. 20,000 quantities into 100, that would be somewhere around 20 lakhs. So 20 lakhs contract value you can just acquire by paying 5 rupees each quantity. It means in just 1 lakh, capital, you can do a business of 20 lakhs. So this is the power of options. And what about futures? If you just multiply, so 3,000 into 100. So you can buy a contract with a price of 3 lakhs 33,000. Under intraday, your capacity would be like, means it goes somewhere around 4 lakhs. And under cash trade, you can only buy maximum, the securities up to 1 lakh because your capacity is only 1 lakh or your capital is 1 lakh. So basically, guys, derivatives, like future and options that help you to acquire more and more quantities in a short capital or in a low capital or in a limited capital, I would say. But here is the catch. If you are taking more, let's say, quantities, or if you're buying more and more contracts by utilizing, your full amount, so you may lose your entire capital because the more risk, more loss. Don't apply logic here like more risk, more profit because the profit percentage in option is very low. Only 2% possibility would be where you can make a profit out of it. So 90% probability would be you will lose your capital. Why? Because of time, because of interest, because of inflation, because of falana. There are a lot of other factors which affects on the options price. There are a lot of, but you should understand this. If let's say why option market is looks more attractive because people, they're coming with 50,000 rupees capital and they're buying the contracts worth of rupees 5 lakhs, and if they have a profit of 5 to 10,000 or 20,000 in a day, so they are saying, look, I made a profit of 20,000, but basically they don't know it. They are risking their entire capital. Let's say if it is a 50, and if if trade goes wrong, they may lose their entire money. And that's why, just because of the more risk factor, in the last 5 years, 98% option traders, they lost everything. And even 4 crore people, they have left completely trading also. They are not doing trading now, including such a big names. Even I have also lost 8 lakhs rupees in derivatives initially, especially in options. Why? Because to purchase options, every time it looks like lucrative because we are buying quantities in crores or contracts in crores. But the option game is risky. But in terms of, let's say, operational risk, there is no risk. There is no risk with future and options in terms of operations, like in terms of, let's say, default, you know, part, because future and options. So this portion, basically, it is a part of. stock exchange, listed on a stock exchange, and parties, will pay premium or margin. So it means the contracts which are secured from the market risk, right? Stock exchange will settle the contracts on time. Parties will receive profit and loss on time. So there is 100% surety with the future and options. The swaps and forward, they are not listed contracts. Basically, swaps and forward both comes under open market, which is OTC, trades. OTC, other way around, you can call it as a open market, like trades anywhere. You can trades anywhere. There are no obligations as such. You can trades anywhere, and you can trades anywhere. You can sign, you can find parties maybe in Mumbai, Pune, Delhi, Bangalore, anywhere, and execute the contracts. You can go to your lawyer. You can, include all the terms and sign the contracts. Because swaps and forwards, they're actually a physical contracts. Future and options, they are a digital contracts and signed through stock exchange. But swaps and forwards, they signed through brokers or maybe legal counsels or attorneys, so that we can sign and execute it. Okay. And if I talk about cash and intraday, that comes under basically listed and unlisted both. Means if it is a listed company, you would see as a listed. If it is unlisted, then you would see under unlisted. Listed both. So this is how market composition is all about for a derivatives. There are a lot of other things. I have prepared presentations for a derivatives part. I would like to take that, but we'll discuss that tomorrow in a dedicated session. We need 3 hours dedicated to go over and discuss in detail. So we'll complete that. But this is how basically guys, derivative works. There are a lot of use cases that you may refer for a, let's say, you know swap. You may, but we'll discuss couple of examples tomorrow, because we have prepared presentation and everything. So I don't want to now get into the same examples and all. So I'll give a lot of examples tomorrow. We have a PPT with stunning charts actually. But this is how guys, derivative works. See, if you ask me, you should not enter into future and options. Means now let's talk about some facts why and what's the reason. You should not, because options looks attractive, but you know your risk could be like, the way the brokers or stock exchange, they're offering, let's say, 100x to 100x, or maybe 90x or 90%, whatever the ratio is. Let's say 90. Even if I consider, let's say, 10x the leverage to hold the options. So it means you are exposing yourself for a 10x risk. Okay. And there are other technical factors in options, like our let's say option Greeks, what we called time, interest rates, or there are other lot of factors. But let me tell you, Even if you try to learn everything, the or try to understand everything, how does it work, still you cannot make profit out of it. The reason is due to brokers, because they manipulate several things. Due to big shark, they manipulate system. They know how to manipulate it, so you cannot make any profit out of it. The terms might looks fancy just for exam preparation, but in reality they are very dark. See, to calculate the actual price of option trades, we have two models, and nobody is perfect on it. Like one is binomial model, and another one is uh, what is the name of that guy? Black and School. Both are, both were like two friends, and they design models to calculate the price of option trades. But both guides, means the both the that those stupid folks, they end up with making huge losses. Huge, it means huge losses. Same for like rich and poor dad. The same guy was giving GAN to the entire world, and suddenly Facebook or YouTube communities, they were talking about you should read this, you should read that, falana, dimkana. But that guy, which is in a huge debt, now facing crisis, looking for a funding to repay a debt, and he has no plan it how to repay that. So it means you should not follow, everyone's like, blind. There is someone is saying, do this, do that. I have a elephant strategy. I have a this bold strategy. You should follow that. You should follow this. No, you should not follow anything, because no one's strategy is like, proven and approved. Everyone is talking about probability. If you do this, you may earn. If you do that, you may earn, kind of this. But what about your own probability? Do you have probability in place? If you have, go ahead and enter in trades or execute contracts. But if you don't know, or if you don't have, let's say, your own understanding of a probability, then you should not enter in future and options, because they are not for you. To expose for a huge risk or unlimited risk or even limited risk, which is not a good at all. Now, if we talk about swaps and forwards, you may look for a swaps or for a forward contracts, right? But if you have a portfolio with you, let's say for a 1 crore or for a 2, then maybe you can enter in the contracts, sign contracts, right? And you can generate extra profit out of it. Let's say now, if your portfolio which is in a huge profit, and you have decided to now make extra steady income from your portfolio, then you can take risk, and you can reach out to the broker, ask broker to help you to sign a swaps contract or forward contracts, and that's how you can make money out of it. But again, as I said, the swaps and forwards, they are not for a middle class people. At least you should have to have a 1 crore or 2 crore portfolio size, then you can think about it. Otherwise, for a 50 lakhs or 20 lakhs, nobody is really interested at all. And we don't have that much of flexibility in place. We don't have any platforms yet which can offer swaps and forward tradings easily on a platforms, so it's become difficult. Maybe I would be the one of the person that I may develop this swaps and forward contracts platform. Now, if I talk about cash trade and intraday trade, see, cash trade, which talks about, you know, if you have a risk capacity, or your capital is 1 lakh, then you can buy the contracts, you know, you can buy the contracts for 1 lakh, or you can buy a the let's say positions, or you can buy what I would say, you can buy the contracts or quantities with the exact value, how much that you have with you. So it means there is no big risk at all if you compare, with the other options. Even intraday is not good at all. If you have a low capital, do not expose yourself and increase, your risk by 4x, because you may lose your hard-earned money. And even the equity part, if you have a proper, research or well research in place, maybe you can, look for investments and you can do it. So that's how you can work around and get the things, uh, like I would say, in place for you. All right. So this was all about the derivatives background, but tomorrow in a session we can have a more detailed discussion around like examples of derivatives for a put, for a call, for futures, how things works, and a lot of things that we can cover tomorrow. But yeah, so I'm done with today's session. I just wanted to cover, the background part. But now, if you have any questions, please go ahead. I would like to ask, means I would like to request you guys, if you have any questions, please go ahead and ask questions. So I'll unmute. You can ask questions as much as you can.